Hello, everybody, and thank you for tuning in to another episode of Ryan's Rules of Investing. In this video, I'm going to go ahead and talk about stocks versus real estate. Pretty good topic. But before we get into it, please don't forget to click like and subscribe. I really appreciate it. It does help the algorithm, and it's good information. I hope you guys can pass it on. With that being said, why stocks? That's the first question. Why stocks? Why not real estate or some other investment opportunity, right? Part of my mission these days is to help educate people on how superior stock investing is to literally any other investment strategy. It's not that you can't make money somewhere else. Plenty of folks have made a lot of money in real estate, but it's harder. It's much harder to do it through real estate. For example, right? You can sell stocks instantly, but it takes a long time to sell a house. You might get lucky and sell a house. Also, you have competition in real estate, whereas in stocks, you just buy what you want, right? You don't need to get a mortgage to buy stocks. There's no interest charged on owning stocks. You don't have to deal with repairs on stocks. You also have to deal with tenants who don't pay the rent on time, the inevitable eviction process, which can be hellacious. Also, you can invest pre-money in stocks where you cannot do this with buying a home. You can't take pre-tax money and buy a home. I know some people will talk about using a self-directed IRA to buy homes, but that's a very, very shifty way of doing things and very easy to get caught with the IRS. I'm not trying to make investments risky. I'm trying to make them easy to do, highly profitable, and with as little work as possible. In the event of a crash, stocks recover their value much faster. And then you don't have to pay big commissions when you buy and sell stocks. On a house, every time you buy it, someone's paying a commission, which ultimately comes out of the sale price. And whenever you sell a home, you have to pay a realtor the same amount. Even if you paid off your home, you still have to pay endless taxes for the privilege of owning it, right? So everyone says, well, once my homes are paid off, I'll have to make a mortgage payment. And that's 100% wrong, because you have to keep homeowners insurance on your home if you're smart. You're not going to pay a home off and then not have homeowners insurance. It doesn't make any sense. With stocks, stocks are liquid. You have an instant exit if needed. Real estate is not liquid. You cannot control the sale. It's a difficult exit strategy, right? It's not within your wherewithal. You just can't go sell a home tomorrow for all your profit and take it out. With stocks, there's no bidding. With real estate, they're hard to buy. There's competition. There's multiple offers which drive up the price. With stocks, there's no financing needed. You could even finance, which is maybe another video. You can buy a margin, but that's not the same thing. With real estate, it's subject to supply and demand, lack of availability. You also have the need to get approved for financing, right? If you don't get approved for the finance, you have too many loans, you're looked at as a full company, it makes it more difficult. So yeah, one of the good things about stocks too is that you can leverage the stocks that you already own to borrow money without actually selling the stock that you have. So let's say I have $100,000 in Tesla stock. Even though I have this money invested with Tesla, if I need to get the money out temporarily, take a quick loan on it, I can do that. I can also, through margin accounts, which is, like I said, another video we can talk about later on. So, a lot of people have a couple $1 million in stocks, and they can go buy a home in cash, actually, if they wanted to, their primary residence, whatever else, just by writing a check off their margin account. And they use the stocks that you have for collateral. Now, privacy. Privacy is a big deal. I mean, everyone that owns homes likes to be private as much as they can. With stocks, no one can look up your investments. No one can look up what you actually own. There's no way to do that. With real estate, it's very, very easy to find for litigation. Even if you try to LLC up and have multiple LLCs, you're still going to be on there at some point. They're still going to follow the money, as they say. I can still see you as a principal or a managing member of the LLC, and it's eventually easy to find. Real estate, if you want to take money out of the house, you need to get financing. You need to pay refinance costs. It's a long process. It's not quick. I can leverage my stocks and borrow against them in a matter of minutes, where real estate, you cannot do that. So stocks, there's no interest. With real estate, you must pay interest to own it. I mean, you have to pay interest to own it. I mean, if you get a mortgage, you're going to pay interest. And think about this too. If you have your house paid off, the amount of the interest rate that you paid off is actually your rate of return, right? So if you're paying a 5% rate on your mortgage, and then you pay your mortgage off, you just save 5% interest on it. So your money is actually making 5%. Where you can make so much more money with the stock market, it's not even funny, right? So when you own a stock, the companies are run by professionals. These are, CEOs, CFOs. You can be as cynical as you want about people that do fraud, blah, blah, blah. But as a whole, right, these companies are run by A-grade people, right? With real estate, you might have a management company helping you do it, but you do need to have active management, whether it's you or somebody else. And it's questionable whether it's even active or actually good management, right? You give a management company that doesn't collect the rent on time, they don't service your people correctly. I mean, the list goes on and on, right? With stocks, there's no holding costs. With real estate, you've got repairs, you have evictions. With stocks, you can buy stocks for income, which means that you can buy stocks and actually have them pay dividends to you. So that's actually your cash flow, right? Real estate, they say that there's passive income and cash flow, but it's really not passive income. And there's cash flow, but you have to work a lot to really get that cash flow. It's a lot to again, with the evictions and everything else. When you sell a stock, you don't have to pay large commissions to buy or sell. On real estate, you're going to have to normally pay, 6% to sell your home? I mean, you might get some discount place. Again, we're not talking about the exception. We're talking about, across the board. And with stocks, you can buy these with pre-tax via an IRA, a 401k, or one of the many plans that are out there. Real estate is always bought with after-tax money. So you have to make a lot more money to find the down payment, to be able to put money into real estate, to do the renovation. If you want to buy real estate, just invest in an REIT, which is a real estate investment trust. So basically, you have a professional company, a real professional company, that owns maybe like 1,000 shopping centers across the country, right? And it's all the underlying stock, the underlying asset of it is not the company, it's actually real estate. It's an investment trust. So you can still be in real estate and still be at stocks at the same time and not have to do all this other work. Debt can get you into bankruptcy, right? So you get 5, 6 properties, you have 5, 6 mortgages, the deck of cards, man, it's like a house of cards waiting to fall. If one goes bad, someone doesn't pay, if you don't have enough reserves, you could end up in bankruptcy. I don't ever like taking debt out, even if they do call it good debt. The house is never really paid off because, again, you always have to pay taxes and insurance. And then when it comes down to owning real estate as not an investment property, but as your primary residence, the primary residence is actually a liability because it doesn't put money into your pocket. It's not really an investment at that point. By the way, I'm actually from the Phoenix area. Maricopa County is where I'm from. And the housing market went up quite a bit. And so I asked myself, I'm like, well, what would have happened? Because at one point I wanted to buy a home. I was going to buy a home. I was getting wrapped up in the craze. Maybe I should get a home. Maybe buying stocks isn't the way. Maybe, I don't want to be wrong. I hear people's houses, they're flipping these homes and making money. In 1976, I thought to myself, what if I invested $100,000 in Maricopa County real estate versus putting $100,000 into the NASDAQ, Dow Jones, or the S&P 500? So I did a complete comparison. Now, why Maricopa County? I chose Maricopa County because it's not New York. It's not LA. It's average of enough area that we can make it a believable comparison to use. Again, I don't want to use Cleveland, Ohio. It wouldn't make sense to do that because Cleveland's different than Miami or Texas. Anywhere in Texas, there's too many other markets. I wanted to go back to 1976 because that's the first year that the NASDAQ started. So that's the furthest data we would have. I don't want to leave out data because from 1950, it just doesn't make any sense. And also we want to keep this based on realistic timeframes, right? With that being said, if we switch over to the screen over here, you're going to see the Excel spreadsheet that I made, basically Maricopa County housing appreciation versus investing. So I went in here and I took historical data from the S&P, the Dow Jones Industrial, NASDAQ, and housing in Maricopa County, the years of appreciation from 1976 up until on here, 2021. Now, we could do 2022 and 2023 is not over yet. We're still doing a year-to-date version of this. So I wouldn't be able to do that. I know 2022, all 4 markets actually went down. So we're just going to keep it here for now just to prove my point. So when looking at here, we've got housing, we've got NASDAQ returns starting at 100,000, Dow Jones, and S&P 500. Now, if I was to put 100,000 in here, and these pink are basically the years that the market went down. So you can see the year 2000, Y2K bubble, and you can see across all 3 markets. This is the 2008, housing market crash when it went down. And, what we're really going to see here is a lot of interesting things. So housing, when you look at 2008, that actually started in 2007 and didn't stop until 2012. It took actually 7 years to recover from 5 consecutive years of losses. It never takes stocks more than a year to come back, except for the S&P in 2008 and 2009. And even now, it's way more. So look at the housing market went down 62% in Maricopa County. But skipping all that, just getting to the bottom line, you'd have $965,000 after everything in 2021 if you had invested $100,000 back in 1976. Let's go to the S&P 500. The S&P 500 doing the exact same thing with no work. You're literally putting $100,000 away and going to sleep and waking up that many years later, you would have approximately $5 million. Dow Jones Industrial Average, a little more conservative, you'd have $4 million. And if you would have invested in the NASDAQ in 1976, a year it started, put $100,000 in and went to sleep, you would have $20 million. So as you can see, over time, no matter what, you're always going to do better in stocks than you're going to do in housing. I mean, even if I took an LA market or I took Miami market, it's still not going to be the same thing. And you would never want to take Florida, for example, because you have sales tax and astronomical taxes you have to pay down there. I mean, there's a million reasons why. But the fact of the matter is, stock is always better than real estate, no matter what. And stock requires no work at all. I don't have to do any work. I'm at my second home right now in Thailand, hanging out, and I don't really have to work because my stocks are doing everything for me. So, like I said, as you can see, stocks always blow away real estate. And you don't even want to start talking about going into a savings account because you're literally losing money. Basically, you want to figure that out, take the amount of money that the bank's paying you and subtract off the inflation rate that your money is in there at. You can see how fast you're going to lose your money. Now, a lot of people may be thinking when looking at this, well, that's great. I'm glad that putting the money in the NASDAQ or S&P or Dow Jones is good. You've convinced me now that stocks are better than real estate. Now what? And that's a great question. You may not know how to invest in stocks, but the good news is I do. And my rules of investing takes you step by step of how to do this. So it's way easier to learn how to invest in stocks than it is to learn by trial and error and a bunch of money being wasted trying to buy a home. It's not that easy. And look at all the time you're going to spend anyway. My book is $27. Spend the $27. That's less than it costs to buy a door handle for a house you're going to buy. Like, it's insane. It's less than a credit report, actually, to go buy a home. Go ahead, buy the book, read it, check it out. Ask me any questions that you may have from it. Learn how to invest stocks the right way, right? You take my Ryan's Rules of Investing. Very simple. It'll take you maybe 2 hours to read the book, and we'll be done. So I hope you guys liked the video. Please don't forget to click like and subscribe. Send it to everybody you know. I really appreciate you guys sticking with me through this somewhat long video, but I appreciate your attention. Have a good day.